Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of market manipulation, understanding tactics, impacts, and how to stay protected. Market manipulation isn't just a buzzword, it's a serious issue that can distort financial markets. From stock price rigging to spreading false information, these tactics harm both investors and market integrity. Regulators are constantly working to combat these schemes, but knowing how to spot them is essential for protecting your investments. Understanding the signs and impact of manipulation can help you stay ahead and make informed decisions. What is market manipulation? Market manipulation refers to intentional actions taken to interfere with the normal operations of financial markets. By creating a false or misleading impression of price movements or market activity, manipulators seek to trick investors and profit unfairly. These tactics can target anything from stocks to cryptocurrency and even commodity markets. While some forms of influence in the market are legitimate, manipulative methods cross ethical and legal lines, posing risks to unsuspecting investors. Types of market manipulation. Market manipulation isn't limited to a single tactic. It unfolds in various forms, each designed to exploit market dynamics. Below are some of the most common types. Pump and dump. This tactic involves artificially inflating the price of a stock or asset, often through hype or misleading information. Once the price spikes, manipulators sell off their holdings, leaving others stuck with steep losses as the price crashes. You've likely seen this in smaller, less regulated markets, like penny stocks or cryptocurrencies. Wash trading. Wash trading tricks the market by creating fake trade activity. It occurs when the same entity simultaneously buys and sells the same asset to give the illusion of high demand. The increased activity can lure in real buyers, only for them to realize later that the demand was staged. Spoofing. In spoofing, manipulators place large buy or sell orders with no intention of executing them. These large orders create a false sense of supply or demand, influencing prices. Once the market reacts, the manipulator cancels the orders and profits from the resulting price movement. Each of these tactics is designed to manipulate perceptions, often leaving everyday traders at a disadvantage. Legal versus illegal manipulation. Not all market influence is unlawful. Legal trading practices differ from manipulation in that they are transparent, within regulatory frameworks, and don't involve deception. Legal trading practices. These include actions like strategic buying or selling to rebalance a portfolio or using public data to make informed decisions. For example, a fund manager reallocating assets based on economic forecasts may affect prices but does so openly, without misinformation or hidden agendas. Illegal manipulation. Illegal market manipulation, in contrast, relies on secrecy and deception. Spreading false rumors about a company, placing fake trades, or conspiring with others to fix prices all fall into this category. Regulatory bodies like the SEC in the US work hard to identify and penalize these practices, but they can be difficult to catch in real time. Think of it this way: legal practices work within the system, while illegal manipulation bends or breaks the system to serve an individual's agenda, leaving others to pick up the pieces. Understanding the line between the two is critical for market participants to spot red flags and avoid becoming victims. Historical examples of market manipulation. Market manipulation has been around for centuries, shaping economies and impacting countless lives. By examining key historical cases, we can better understand how these tactics evolved over time and their real-world consequences. Below are 3 infamous examples that highlight the destructive potential of market manipulation. The tulip mania of the 1630s. One of the earliest recorded examples of market manipulation is the tulip mania in the Dutch Republic during the 1630s. Tulips, imported from the Ottoman Empire, became a status symbol, and their demand skyrocketed. Speculators seized the opportunity to artificially inflate tulip bulb prices. At its peak, some tulip bulbs were sold for more than the average annual income of a skilled worker. But who drove these prices up? Wealthy investors and middlemen orchestrated bidding wars and spread exaggerated claims about certain tulip varieties being more valuable. This created a frenzy where buyers believed they could flip bulbs for huge profits. Eventually, the market collapsed. Prices plummeted overnight as people realized the hype had no foundation. Many lost their life savings, and the Dutch economy took a hit. While it's often debated whether this was a true bubble or just speculative behavior, tulip mania set a precedent for how misinformation and greed can destabilize markets. The 1929 stock market crash. The 1929 stock market crash was one of the most devastating financial events in history, leading to the Great Depression. It wasn't just reckless speculation that caused the crash, manipulation played a significant role. Leading up to the crash, pool operators would secretly team up to boost stock prices. These influential groups of investors would buy large quantities of a stock, spreading optimistic rumors to attract public interest. As naive investors rushed in, these operators discreetly sold their holdings, leaving others with steep losses. Broker practices like margin trading, where people borrowed money to invest, also made things worse. When prices started falling, brokers called in loans, forcing investors to sell at a loss, which created a domino effect that wiped out billions in wealth. This kind of manipulation and lack of regulation exposed the fragility of the financial system at the time, prompting reforms like the establishment of the Securities and Exchange Commission, SEC, to prevent similar occurrences in the future. Enron scandal. More recently, the Enron scandal of the early 2000s stands as a glaring example of corporate manipulation. Enron, once seen as a darling of Wall Street, manipulated its financial statements to inflate stock prices and falsely project profitability. But how did they fool so many? Enron used accounting loopholes and special purpose entities, SPEC, to hide debt and inflate earnings. Essentially, they cooked the books to create the illusion of success. Executives like Jeffrey Skilling and Kenneth Lay painted a rosy picture of the company's future, luring in investors and pushing stock prices to all-time highs. Behind the scenes, they sold off their shares while encouraging employees and the public to hold on to theirs. The fallout was catastrophic. When the truth came out, Enron's stock price plummeted from nearly $90 to less than $1. Thousands of employees lost their jobs and pensions, and investors were left with nothing. This scandal didn't just expose corporate greed, it highlighted systemic flaws, leading to reforms like the Sarbanes-Oxley Act aimed at improving corporate accountability. Historical examples like these show us just how damaging market manipulation can be, not just for individual investors but for entire economies. By studying the past, we can better recognize warning signs and push for stronger protections in today's financial markets. Recognizing market manipulation. Market manipulation strategies often leave behind clues that can be identified with the right tools and knowledge. While not always obvious, patterns and behaviors in the market can reveal when manipulation may be at play. By knowing what to look for, traders and investors can better protect themselves from falling victim to these tactics. Common indicators of manipulation. Certain behaviors in the market can act as red flags for manipulation. These irregularities often stand out from standard trading patterns and shouldn't be ignored. Here are some of the most common indicators. Unusual price movements. Abrupt price changes that lack a clear reason, such as news or earnings reports, may signal tampering. If a stock skyrockets or crashes seemingly out of nowhere, it's worth analyzing further. Volume spikes. A sudden increase in trading activity, particularly when it's not matched by news or fundamental shifts, can indicate manipulation. High volumes with no apparent explanation often point to tactics like pump and dump schemes. Order book irregularities. Watch for large buy or sell orders that suddenly disappear, which could signal spoofing. These phantom orders aim to create a false sense of market direction. Pattern breakdowns. When a stock or asset consistently behaves erratically or moves against broader market trends, it might be influenced by manipulators. Look for repeated deviations from expected patterns. Misleading news or social media hype. Manipulators often use rumors, fake news, or exaggerated claims to stir up excitement or fear. They may create a buzz through social media or forums to lure unsuspecting traders. By remaining alert to these signs, you can question market activity and maintain a cautious approach when something feels off. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.